Now that we're officially in a new year, some people have asked me if I'm planning on making any changes in terms of my portfolio and how I invest this year. In 2024, I made some shifts in my portfolio, and this year I also intend on making some changes. Likely the biggest change I made last year was become a lot more diversified. And by doing so, I became a little less BDC heavy as this sector made up a pretty big portion of my portfolio. I spent a lot of the previous year expanding into a couple of new sectors, and in 2025, I plan on continuing to build out this plan. So in this video, I'm going to go over some of the plans I have this year in terms of my high yield investing strategy. First, some general goals. The first move I intend to make in 2025 is to simply just invest more. I slowed down a bit last year, and I didn't invest nearly as much as I would have liked to have. According to my Vanguard account, I invested a little under $27,000 last year in high-yield dividend stocks, and this does not include reinvested dividends. That's all from deposits I made from my bank account, and I'd like to get this number up this year. Second, I've also been monitoring various positions, which include new covered call funds, REITs, closed-end funds, and so on, that I might actually decide to invest in this year. If we're talking about a newly launched investment, I like to monitor them for a while before making an investment decision. One of my plans this year, or at least early in the year, is to invest more in REITs. I talked about last week how REITs have taken a massive hit in share price since late November. There's a few reasons for this, but it's mostly due to inflation sticking around for so long. But these investments are still doing great and are offering insanely good dividend yields right now. REITs are the lowest yielding asset class that I own in my portfolio, aside from my single diversified dividend growth ETF, SCHD. But they also provide me with some of the biggest long-term dividend growth that investors like us need. When you're living off dividends, you need to make sure your income keeps growing to account for inflation. If you're planning to retire when you're making $5,000 a month in dividends, what's going to be your game plan when everything's going to be more expensive in 20 or 30 years? And it won't even take that long to start feeling the pain. So it's a good idea to hold some investments that offer long-term dividend growth. And the best part is right now, a number of these ultra-safe investments are offering very high yields. Normally we see these investments only yield around 3 to 4%, and many right now are offering yields upwards of around 6%. So right now is a really good opportunity that I've already been taking advantage of this year. Out of all the high-yield sectors that exist in the market, REITs are likely trading at the biggest discounts right now out of all of them, which is why I'm taking advantage of this opportunity early in the year. 2025 is also likely to be a good year for the energy sector. With leadership changes both in the US and Canada, we should see a better environment for oil and natural gas companies. Donald Trump has been a vocal supporter of oil, and I'm betting that now that he's in office, he'll follow through on his plans to lessen regulations on this sector. His tagline, "Drill baby drill," has even become one of his most famous catchphrases, so he should undo some of the policies that Joe Biden put into place during his presidency. Of course, we now also have another important change in leadership going on in Canada, as Justin Trudeau recently announced his resignation. We don't yet know who's going to replace him, but a lot of people are speculating that whoever does replace him will bring less liberal policies as far as energy is concerned. A lot of oil and natural gas stocks have already gone up quite a bit over the past few months. My current favorite natural gas company, Enbridge, has exploded in share price over the past 6 months. They're a Canadian-based company that provides energy all throughout North America, and with Trudeau gone, these kind of stocks should hopefully continue to perform well. If Canada's going to become less focused on green energy, this could lead to a better environment as far as expanding pipelines. A master limited partnership that I own, MPLX, has also done extremely well over the past few months. They just increased their quarterly dividend by 12.5%, the largest increase in their unit's history. For master limited partnerships, they aren't referred to as shares, but rather units, and if you hold units, you're considered a unit holder and not a shareholder. But MPLX isn't the only company that'll hopefully continue to do well. Energy Transfer is another master limited partnership that's done really well and will hopefully continue. Another company in this sector is Enterprise Product Partners. They've also been doing really well over this past year. As a disclaimer, MPLX, ET, and EPD come with K1s, which are extra tax forms you'll be required to file with your taxes every year, so look into that if you're interested in any of these MLPs. Another goal I have this year, which is a pretty minor goal, is to invest in more preferred stocks. Last year was my first year investing in this category, and although I don't intend for it to become a huge part of my portfolio, I haven't built it up quite enough in my opinion. That might look like buying additional preferred stocks or investing more in my favorite preferred ETF, ticker PFFA. As of the making of this video, preferred holdings only make up about 2.5% of my portfolio, and I've been working to get this percentage up, because preferreds have a lot of great benefits for income investors. They function like bonds in that they offer a consistent dividend that's a higher priority than common stock shareholders. Before a company can pay dividends to common shareholders of their stock, they first have to issue preferred shareholders their dividends. Just like the bond market, most preferred stocks are currently trading at a discount. So right now, these investments are still looking really good. They don't usually offer much growth, or at least substantial growth, but they do offer stability with yields typically greater than 8 or 9%. Another goal I have for 2025 is to become more internationally diversified. Just like preferreds, my international exposure is something I'd like to build up more. That could look like buying individual companies or an ETF that holds non-US stocks. I've heard from international viewers that depending on the country, it's not unusual to see non-US dividend stocks offer higher yields. I can't confirm this, and maybe someone in the comments can, but someone once told me that an 8% yield on a dividend stock from Australia isn't that uncommon. Unfortunately, it looks like Vanguard doesn't allow people to buy ASX-listed stocks, so it's something I'm going to have to look into more. Of course, international dividend stocks would come with additional tax considerations. Enbridge is a Canadian company that I own that involves an ADR, which does come with an additional fee, but my returns from this stock have made it well worth it. Then finally, one of my last goals is to remain patient for the bond market to recover. Specifically with a few closed-end funds that I own, they've been struggling to recover as interest rates have remained higher for longer. Many of the PIMCO funds have been taking a long time to recover, which I'm still holding on to PDI and PTY. PTY has been doing better, but PDI is still lagging a lot. I consider both funds to be higher risk than everything else I've talked about today, but I'm still choosing to wait things out. My plan is to keep reinvesting all of my dividends back into these two funds and potentially buying a small number of additional shares besides that. In terms of anything like rebalancing, I don't normally do this on a yearly basis. With my investments, if one's working out really well, then I don't want to sell shares for the sake of becoming more balanced. I have faith in most of my underperforming stocks that they will eventually recover. I'm doing better with Realty Income, but I'm still down quite a bit from buying too much at the wrong time. As of right now, I'm only planning on unloading one position, PCM, from my portfolio. The last couple years have been really exciting for these new options-based ETFs. This category of dividend investments has been exploding in popularity, and new ETFs are being launched all the time that offer really great yields. There are continuing to be lots of new investment options coming out that I'll cover throughout the year. But that's going to be my game plan for 2025, monitoring various new positions, including new options-based ETFs and other investments. I'll also focus more on REITs and expanding more into energy and probably utilities. It's all about taking advantage in the changes of leadership. There's a lot of options that exist out there in these sectors that offer yields exceeding 8% or more. I plan to continue to reinvest all of my dividends unless some of my holdings become very overvalued. When that happens, I usually like to use the dividends to buy other positions I have. But that's what I have planned for the new year unless new developments happen. Thanks for watching, and here's to a fruitful 2025. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.